Good afternoon, everyone. With great enthusiasm as the sun shines bright on a winter afternoon, I, CS Dr. Pooja Rahi, welcome you all to the very first ICSI webinar session of the EEE 4.0 Master Knowledge Series of the year 2025. And with that, on behalf of the ICSI, we would also like to take this opportunity to extend our heartiest wishes of the new year. May this year, 2025, be a happy, healthy, and prosperous one for each of you and your loved ones. They say the great aim of education is not knowledge, but action. The EEE 4.0, with its focus on contemporary topics and experts with their tremendous knowledge and experience in the same areas, intends to guide the governance professionals into acquiring and updating knowledge and putting it to action. The session today will be focusing upon one such topic which has opened new doors of avenues and opportunities for the company secretaries. That is, valuation of securities, the legal requirements. Valuation of securities per se is a critical process that ensures transparency, fairness, and compliance in financial markets. Legal requirements for valuing securities are designed to safeguard investors, uphold market integrity, and prevent fraudulent activities. Additionally, the legal framework often imposes duties of care and due diligence on valuers to ensure the methodologies employed are appropriate and reflect market conditions. Thus, it becomes imperative for professionals doubling up as registered valuers to understand these legal nuances in the best possible way and to explore the intricate details of the various aspects pertaining to the valuation of securities. We are joined here by CA Tarun Mahajan, an All India rank holder in the Chartered Accountancy examinations, a chartered financial analyst and certified valuation analyst from USA. He himself is a registered valuer undertaking valuation assignments across India, a national level faculty for valuation courses, and having taught valuation to more than 5,000 practicing CA, CS, and CMA. He has also been a part of the research committee on valuation set up by the Ministry of Finance. Sir, it is indeed our privilege to have you here amongst us for deliberations on the topic, and we welcome you to the ICSI platform.
Thank you, ma'am.
Benjamin Franklin said, and I quote, "Tell me and I forget, teach me and I may remember, involve me and I learn." With the intent of involving all our members in these EEE sessions, a link for sharing questions has already been communicated with all of you, and we sincerely hope that you'll be making good use of the same. Your questions will be taken up whether in between or after the session. With this, I would request Mr. Tarun to kindly take the session forward. Over to you, sir.
Thank you. Thanks a lot, Pooja ma'am, for such a nice introduction. And I welcome all the members here in the very first session of the year 2025. And I wish that throughout this year, you keep learning new things and keep growing as a professional. So I would just like to share my presentation with you. Give me a moment, please. All right, so here we go. Valuation of securities. What are the various statutory requirements under the Companies Act, under the Income Tax Act, under the Foreign Exchange Management Act, under the Insolvency and Bankruptcy Code, and under the Security and Exchange Board of India guidelines? And more important, what are the professional opportunities available to practicing as well as non-practicing company secretaries in the arena of valuation? Look, when a company comes up with a public issue of its securities, it is the merchant banker who takes care of everything. In fact, it becomes the duty of a merchant banker to arrive at a floor price as well as a cap price, that is to decide a price band within which the security will be actually issued. And the merchant banker has its own ways of determining the price band. Once the price band is decided, thereafter the company comes up with a public issue and public bid for it. And once the share is listed, the price is discovered by the market forces. But what about the unlisted public companies as well as private companies? When they make issue of their securities, the question is the security issued at the fair value? Or isn't it a situation where the directors are making favor to some of their known people by issuing securities at a very lower price? So that is why the Companies Act 2013 introduced the concept of valuation of securities, which says that if you want to make allotment of shares, even if it is a very small private placement by a startup, you first need to go to a registered valuer and get done the valuation of security. He'll calculate fair value of equity share of the company. And suppose he says that fair value per share is 500 rupees. Now the company cannot issue its securities below this price. This is what the basic concept of valuation of securities is. Now this will actually, there are many more such sections. So we will explore it one by one. So as we move forward, whatever doubts you have, you keep posting those doubts, and our host will accumulate all those doubts, and in between, say every 10-15 minutes, I'll keep answering your doubts. So I encourage you to keep asking and make this session interactive, because we don't want it to be a webinar where I'm the speaker and you're the listener. So keep asking. In fact, if you have any practical difficulties in the area of valuation, or if you have any specific experience which you would like to share with the entire audience, then we will be really happy to share with all. So these are some of the major sections under the Companies Act 2013, which requires valuation by a registered valuer. When I say registered valuer, I'm sorry, in India, registered valuer means a person who is registered with Insolvency and Bankruptcy Board of India, IBBI, as a valuer. So how do you register yourself with IBBI as a registered valuer? The first requirement is you must have at least 3 years of experience as a company secretary. Let me tell you, company secretaries, chartered accountants, cost accountants, and MBA finance people can pursue this course. So I would like to tell you one more thing, that at IBBI, there are 3 categories of valuers which may be registered. Valuers for land and building, valuers for plant and machinery, and valuers for securities or financial assets. For land and building valuation examination, you need to be an engineer, civil engineer, or architect having required experience. For plant and machinery category valuer, the engineers, which are mechanical engineers, they can pursue the course. And for SFA category, securities or financial assets category, company secretaries, chartered accountants, cost accountants, and MBA finance people can pursue the course. For that, you need to have at least 3 years of experience as a company secretary. Thereafter, you can register yourself with any of the RVOs in India. Like there is an RVO which is called ICSI RVO. You can register yourself with ICSI RVO once you have 3 years of experience as a company secretary. And then you undergo a 50 hours of the training. So I'm one of the trainers in that session. Then you undergo 50 hours of the training. And once you complete this training, then there is an online examination which can be given at the centers, NISM centers. You book a slot for the examination. It's not an easy exam to crack. You need to study honestly for it. And once you crack the examination, then you register yourself with IBBI, and then you are called a registered valuer. Eligible to do valuation under Companies Act, under IBC, and under some of the guidelines of SEBI. We will explore it one by one. Let's first talk about the requirements under the Companies Act, where valuation is actually compulsory. So these are some important sections. Section 54 for sweat equity shares, 62 for preferential allotment of equity shares, 67 which talks something about buyback, 192 for dealing with directors, 230 to 236 sections related to merger, and then 281 section related to winding up. I would like to discuss not only what are the statutory requirements, but what are my practical experiences with respect to these sections. What are the practical difficulties faced by a company secretary, by the auditor of the company, by the management of the company, and by a registered valuer. So let's discuss it one by one. First, I would like to talk about sweat equity shares. There are two things. One is called sweat equity shares, and another one is ESOP. Sweat equity share part is covered under section 54, and ESOP we will talk about it under section 62. Practically speaking, ESOPs are really very popular, especially in case of the startup companies. But sweat equity shares are not so popular. Reason being, as soon as you allot sweat equity share, it immediately becomes taxable in the hands of employee in salary head. And in case of ESOP, suppose you are saying that vesting period is 3 years, and after 3 years you can buy equity shares in the company, and today you are granting ESOP. As of now, there is no income tax on the employee. It is only when he exercises the option. So there are two advantages. Number one, the taxation impact is deferred under ESOP. And number two, the employee remains with the company for 3 years to exercise the option. Say if we are giving 3 years vesting period, for example. So that's why sweat equity shares are not so popular. Still, many companies, they do prefer to issue sweat equity shares. So whenever a company is planning to issue sweat equity shares, it need to obtain valuation report from registered valuer. And there are two valuations which are actually required. You don't need two separate valuation reports. In a single valuation report, these two valuations may be incorporated. One is valuation of the intellectual property right for which sweat equity shares are being issued. The whole concept of sweat equity is that you are working for my company. You are a fantastic guy. You are applying your mind. You're giving us know-how. You're giving us your coding skills, your intellectual property right, which we are using to make our product. So what is the value of that intellectual property right? Is it worth 50 lakh rupees or 5 crore rupees or 10 crore rupees? And then what is the value of the equity shares of the company? These two valuations are actually required. See, making valuation of equity shares is something routine for a registered valuer. But making valuation of intellectual property right at times become challenging, especially identifying the contribution of an employee in the growth of the company, in the profitability of the company, what he has actually contributed so far to the company, what he is expected to contribute to the company. So when you come to me that Tarun, okay, make valuation of intellectual property right for the purpose of sweat equity shares, I'll ask this question, that what difference will it make if this employee is there in the company or if he is not there in the company? It is like with the employee or without the employee, what difference will be there? Theoretically, it sounds very simple that, okay, with the employee, the company will grow at 8% per annum. Without the employee, the company would have grown at 2% per annum. Theoretically, it sounds good. But practically, identifying an employee's contribution in the company is really a tough task. So we make two valuations, one of the intellectual property right and one of the equity shares of the company. Besides obtaining valuation from a registered valuer, the company also have to obtain valuation from the merchant bankers. Because under the Income Tax Act 1961, so far the word registered valuer who is registered with IBBI is not there. Registered valuers usually don't do valuations under Income Tax Act except few. So you need a merchant banker. As soon as you plan to issue equity shares, you'll have to appoint two professionals. One registered valuer for valuation under Companies Act and one merchant banker for valuation under the Income Tax Act. Because once you give sweat equity share, it immediately becomes taxable in the hands of the employee. And in the hands of employer, there is a liability to deduct TDS. So when you deduct TDS, you need to know the income. To know the income, you need to know the value of sweat equity shares. So last month only, I was working on one of the assignments where a foreign company was giving its equity shares to the employees of Indian subsidiary, sweat equity shares. And for that, they need to do TDS. And for TDS, they actually need to get done the valuation. So this is one thing, issue of sweat equity shares, you need a valuation. The second most frequently used section with respect to valuation is section 62. 62(1)(c). 62(1)(a) is right issue of securities under the Companies Act, and 62(1)(c) is preferential allotment of equity shares, maybe for a consideration which is cash or maybe for a consideration which is not cash. When I say preferential allotment, it clearly indicates that we are not making allotment to existing equity shareholders. Rather than maybe we are making allotment to some new people on a private placement basis. So as I said at the beginning, the question is at what price? So you see in the Shark Tank that an entrepreneur makes a presentation and then sharks decide some price, and then they there is a deal, and then sometimes they issue symbolic check also. But after that, a lot of formalities will be there. That symbolic deal is not a final deal. Thereafter, the team of the shark will do the due diligence, the legal due diligence, the financial due diligence, the commercial due diligence. And if they find that that buddy was lying in the show, then the deal will not actually materialize. And in fact, after that, they'll have to come to a registered valuer to make the valuation of security, and which will be filed with the registrar of companies. So the question is, when you make allotment of equity shares, what is the fair price? Board of directors cannot decide this is the fair price. It is the registered valuer who will decide this. So let me tell you here that valuation is compulsory. So I practice full-time as a registered valuer. I don't do anything else. I mean, as far as practice is concerned. So when I meet people and I say, look, I do valuation of securities, they say, oh, no, we have only small companies in our pocket. We don't need valuation. Then I need to tell them that, look, valuation is required by the smallest possible private company also. Last week only, I was doing valuation of a company which was newly registered, and they were getting some fund from somebody because they got a fantastic idea. So company was just having 1 lakh rupees of paid up capital, 1 lakh rupees of bank balance, full stop, private company, nothing else. But to make allotment of share to a third person who is not already shareholder in a company, they needed the valuation report. So it is the misconception of many people that valuation is required for the big companies. It is required even for the smallest possible company to the biggest possible company if it is making preferential allotment of equity shares. The question is, what if the allotment is made for consideration other than cash? So the company bought a business from proprietor, and for that business they are issuing equity shares. Or company acquired a partnership firm and they are issuing equity share, or company acquired some land, building, plant, machinery, intellectual property right, or anything, and then they are making allotment of equity shares. In that case, you need two valuations. One, valuation of equity shares of the company, and number two, valuation of the consideration, that is valuation of the business of proprietorship, or valuation of business of the partnership, or whatever other asset you are acquiring. So this is the requirement. Valuation is not required in case of right issue of securities. So sometimes, the client is reluctant to pay fees to a registered valuer. That, oh, I'm making some small stuff, and why should I pay to somebody for getting the valuation? And sometimes the client themselves or some professionals advise them, let's do one thing, that we will first make a right issue, because for right issue you don't need a valuation report. We will first make a right issue to the existing shareholders, and you see, then you renounce the right to the third party to whom actually you wanted to allot the shares. Now, looks like it's a smart move, and you have avoided the fees to be paid to the registered valuer, because renunciation of right is there, so no valuation is required, and for right issue again valuation is not required. But keep in mind, if the existing shareholders are renouncing their rights, the right issue was originally made at 10 rupees, but otherwise the issue price is 500 rupees. If they renounce their right, they'll be getting 490 rupees from that body, and that will be chargeable as income in the hands of those people, and that can be huge. So never ever advise any such thing to the client. It is better to make a direct preferential allotment. Second interesting situation is, so sometimes say there was a situation, husband was holding 70% shares in the company and wife was holding 30% shares in the company. It was a closely held company. It was a private company, in fact. So 70 and 30%, 70 lakhs, 30 lakh rupees of the paid up capital, like that. And see what happened, that practically in the income tax file of the wife, more capital was available. So wife introduced that money in the form of unsecured loan. I mean the loan by the director to the company. Husband also gave some loan to the company. Let's say wife gave a loan of 1 crore rupees to the company, and husband gave loan of 20 lakh rupees to the company. So this 1.2 crore rupees was sitting in the form of unsecured loan from the promoters directors in the balance sheet of the company. Now this company approached to a bank for further loan. Bank said, look, your existing paid up capital is insufficient for us to give you the loan. Increase your paid up capital. So they thought, let's convert this unsecured loan into equity by allotting shares. And now they were thinking that we are making allotment to the two people who are already shareholder in the company. So it is a right issue and we don't need a valuation report. While in fact, this is not a right issue, sir. You know why? Because the proportion is changed. Currently, they are holding shares in the ratio of 70-30. And now that 30% stakeholder will be getting share worth rupees 1 crore. And the 70% stakeholder will be getting share worth rupees 20 lakhs. So even if you are making allotment to existing equity shareholders only, but the proportion is not maintained, in that case, it disqualifies as a right issue, and better you should obtain a valuation report for this. Now look at this. So the situation is, I get these cases because the company, in fact, in one case, I got a situation where a startup was there and they made, in last 1 year, they made 2 or 3 allotment at 2 or 3 different point of times. And they were not really aware that any valuation is required. So after making allotment, they even filed the PAS 3 form with ROC. And somehow it got undetected at the end of ROC also, that as an attachment to this form, valuation report is not there. Whenever you file PAS 3 form with the ROC for preferential allotment of equity shares, With this form as an attachment, valuation report must be there. So it somehow got skipped at the ROC end also. And after 1 year, they approached me and they said, look, we need a valuation and it should be signed on that date. I said, sorry, I don't do backdating. And in fact, chartered accountants and company secretaries are supposed to generate UDIN, unique document identification number, and that cannot be backdated. So, like in as a chartered accountant, I can generate UDIN up maximum up to 60 days from the date of signing the report. So something must be there, like with the ICSI also. Otherwise, also backdating is a bad idea. But I said that look, forget me, मैं तो वैसे भी नहीं sign कर रहा. I'm not going to sign it anyways. But nobody can sign it because the UDIN requirement is there. So once this deficiency is there, it is non-rectifiable. Practically, it is really tough to rectify this situation. So it's better to obtain a valuation report here. Now let's talk about ESOP. So ESOP are really very popular with startups, and it is a fantastic way. Without giving money in cash to employees, you can retain talent. I've seen many people who have been working at a profile in well-established companies as software engineers or some consultants, and then they left those companies and then they joined startups. There are two reasons. They say, number one, in a very big company, out of a very big business, I have just a pinpointed routine task. I don't get challenges. I am not able to utilize my talent over there. Once I join the startup, my talent will be utilized. And number two, these guys give me some cash and they will offer me shares also, because they are not in a position to give the whole remuneration in the form of cash. So they are going to offer you shares in the form of ESOP. And once this company flourishes, now this is speculative though. Once this company flourishes, I will earn huge money out of it. So even employees like ESOP, and even the company likes to give the ESOP. If you are making allotment, I mean you're granting ESOP. So there are three stages. First you grant the ESOP, then after at least 1 year and maybe up to 4, 5, 6 years, it will be vested. And once it is vested, thereafter it will be exercised. You don't need a valuation report to be filed with registrar of companies. There is no form which requires a valuation report to be attached at the time of grant of ESOP. When you grant ESOP, though you obtain a valuation report, but it is not filed with registrar of companies. So you might be thinking that if I don't have to file it, why should I obtain it? The reason is for the purpose of its accounting. Because once you grant the ESOP, it is like it should be charged over your profit and loss account over the vesting period. If the vesting period is 4 years, then this expense of ESOP should be charged to P&L in 4 years time period. What to charge on P&L? For that, you need to get done the valuation. And that should be done by the registered valuer, because Companies Act section 247 says that whenever there is a requirement of valuation under this act, that must be done by the registered valuer. Not by the merchant banker, not by a practicing chartered accountant, not by cost accountant, not by anybody, but only by the registered valuer. But keep in mind, suppose the vesting period is 4 years, and after 4 years, employee exercises its option. When employee exercises his option, at that time, you will need a valuation report from a merchant banker, because that will be taxable in the hands of employees. At the time of grant, you need valuation report from registered valuer, and at the time of exercise, you will need a report from merchant banker. So this is something which should be kept in mind. If you are giving multiple vesting periods. So on those multiple dates, some of the companies they say first vesting will happen after 1 year, and thereafter every month vesting will keep happening. And what if employee keep exercising every month? Then you will be in trouble. Every time he exercises the option, you will have to obtain the valuation report, and you will have to do, we are allotting shares, so you'll have to do the ROC formalities also. So it should not be really very frequent. You can say after 1 year, first vesting will happen, and then every half year, the vesting, more shares will keep vesting up to the end of 4 years. Something like that should be planned. Okay. Now, besides the allotment of equity shares, you need a valuation even for the situation when a company is issuing convertible securities. So, what are the examples of convertible securities? It can be CCPS. It's a very popular instrument with all the startups, compulsorily convertible preferentials. Then there are OCPS. I don't see it frequently, but yes, some of the established companies they prefer to issue OCPS. Then there are CCDs, compulsorily convertible debentures. Then there are OCDs, optionally convertible debentures. If you don't fulfill all the proper conditions in OCD, then it may be treated as deposit. You need to be cautious about it. And now there is this new instrument which is called SAFE. And the full form is Simple Agreement for Future Equity. It's an American concept, not the Indian one. And in India, they started calling it iSafe, I for India. So there is no such word in the Companies Act which is safe. If you properly analyze any SAFE agreement, you will realize that it is nothing but CCPS. It should be treated like that only. Companies Act does not recognize any instrument which is called SAFE. The question is, why do I need a valuation? And the answer is straightforward, because one day this will be converted into equity shares. And whenever equity shares are allotted, the government wants to make it sure that it is not allotted below the fair value. Yeah. Rule number 13, the company share capital and debenture rules 2014. Rule number 13, if I'm not wrong, sub rule number 3 says that you can make allotment at or above the fair value certified by registered valuer, not below the fair value certified by the registered valuer. So one day these securities will be converted, and that's why you need a valuation. Now there is $1 million question where even the seasoned professionals get confused. When do I need a valuation? At the time of issue of the convertible security, today, or at the time of conversion of this security into equity shares, say after 3, 5, 10, 20 years. This is where people get confused. Rule number 13, sub rule 2, clause H, if I'm not wrong, because the Bayer Act is not open in front of me. So rule number 13 2H of the share capital and debenture rules 2014 is talking about this. And the language is little ambiguous, I'll tell you. But my interpretation is, see, the language says that in case of convertible securities, you have a choice. Either to obtain the valuation report today, I mean at the time of issue of convertible security, or you can obtain it at the time of conversion. 30-60 days time period is something given at the time of conversion of the security. So by plain reading, you will think it's my choice, either to do it today or to do it say after 5 years. But I'll tell you the correct interpretation. There are two types of convertible securities. One with a fixed conversion ratio, that CCD, okay, CCD 2:1 conversion ratio. One debenture will be converted into 2 equity shares. Conversion ratio is decided as of now. And second is CCD is convertible after 5 years at the fair value of equity share at that time. It means today you are giving me 1 crore rupees in the form of CCD. I don't know how many equity shares I'll give you. Let's wait for 5 years. After 5 years, if the fair value of equity share appears to be 1000 rupees, then this 1 crore rupees will be divided by 1000 rupees fair value after 5 years. That will be known obviously at that time only, will be say 10,000 number of equity shares I'll give you. So this is called the variable conversion ratio. So if the fixed conversion ratio is there, valuation must be obtained at the time of issue of convertible security today, not at the time of conversion. Because at the time of conversion, there is no point of getting done the valuation. You have already decided that I'll give 2 equity share for 1 debenture. So for 10,000 debentures, say for example, I'll give 20,000 equity shares. It is pre-decided. So what is the point of getting done the valuation at that point of time? If the conversion ratio is fixed, you must obtain the valuation report today, attach it with the PAS-3 form while filing with the ROC. On the other hand, if you are saying that, say it is CCD or CCPS, and it will be converted at fair value at the time of conversion, there is no point in obtaining the valuation report today, because today's fair value hardly matters. What matters is fair value at the time of conversion. But there is a practical problem. Sometimes at some of the ROCs, they tend to reject Form PAS-3, saying that this is convertible security and valuation report is not attached. So I'll tell you a practical solution for this, what I actually practice. So we give a compliance report instead of a valuation report. It is like a 1-page or 2-page report where we say that, look, the company is issuing convertible security. It will be converted into equity shares at fair value at the time of conversion. At that time, the valuation report will be obtained. So today they are not obtaining any valuation report, and this is in compliance with rule number 13(2)(h). This compliance report issued by a registered valuer, signed by a registered valuer, UDIN generated by a registered valuer, is issued to the company, and company attach it with the Form PAS-3. And this is how there is an attachment related to valuation, something like valuation is appearing, and the guys are happy that, okay, the compliance is done. And at the time of conversion, then you obtain the valuation report. So this is the practical thing. Now, there is one very popular thing for which I think there should be some dispute. Somebody must raise a concern and the law needs to make provision for it. Startups nowadays, what do? They say, look, I am in need of money. You give me 1 crore rupees in the form of CCPS or in the form of CCD or in the form of SAFE, simple agreement for future equity. In startup language, they call it unpriced funding, unpriced round of funding. I'm a new startup. I have got a fantastic idea. I have done the research and idea looks very good. My experience and my qualification is also fantastic, but I have not yet started generating revenue. Now that's the problem. When a startup, pre-revenue startup, comes to me as a registered valuer and say, look, Tarun, make valuation. So mostly we make valuation using the DCF method, discounted cash flow method. Now, what does that mean? We forecast the future cash flows. I mean, management forecasts future cash flows. We discount those cash flows, make sum total, and then we say this is the fair value. For a pre-revenue startup, you can forecast whatever you like to forecast. My first year sales will be 10 crore. Then it will be 100 crore. Then it will be 1000 crore. Or you can say it will be 10 lakh and then 20 lakh and then 30 lakh rupees. So you can project whatever you wish to project. I usually tend to deny to make valuation. That, see, you're a pre-revenue startup and you don't have any track record, even as a promoter. So how can I believe that whatever projections you have given are the reliable one? So usually even startups don't go for valuation in this initial stage. They get unpriced funding. That is, issue CCPS worth 1 crore rupees and say that whenever our next funding round happens, which will be the priced one, say in 2 years' time, with this money we will grow in 2 years, we'll start business, we'll grow in 2 years, and then we will need more money. At that time, we will get done the valuation, and that second round will be the priced round. So whatever price issue price will be there at that time, at the time of first priced round, we will convert your CCPS into equity share at that price minus some 10, 20, 30% discount. So you give me money today. After 2 years, when I issue shares at 1,000 rupees, I'll convert your CCPS into equity at 1,000 minus say 20%, which is like 80%, 800 rupees. Your conversion price will be 800 rupees. This is something really very popular in the startup space. My personal opinion here is, see, you need a valuation only at that time of conversion because today it is unpriced. So you will need valuation. But my personal opinion is, even as of today, there should be some provision to watch that unnecessarily high discount is not offered. That after 2 years, whatever issue price is there, I'll give you 80% discount to that issue price. Maybe you are making favor to some people. So there is no provision in the law with respect to this discount which is offered, not discount on par value, discount on the issue price. There is no provision in the law so far, and someday will consider it, and maybe then some amendment in the law will be there with respect to that. Okay, so well, ma'am, do we have any questions so far?
So actually, we have plenty.
Okay, I would like to hear then.
Let's begin. A common question that I have is, many of the company secretaries are asking that whether they need to be in practice only or can they do it while being in employment also.
Okay, that's interesting. So you can register for the course even when you are in employment. There are people who are in employment and who are planning to start their own practice in near future. So even when you are in a job role, you can register yourself with ICSI RVO once you complete 3 years of experience as a company secretary. Get registered for the course, attend 50 hours of the training, appear for the examination, clear the examination. But even after clearing the examination, you will not get the membership, because here membership and certificate of practice are not two different things. It is one and the same thing. Getting membership is like getting certificate of practice. Now, being in job role, you cannot get certificate of practice as a registered valuer. But there is one interesting thing, that they have given a time period of 3 years. Once you clear this examination, within 3 years, you can get registered as a member. So in next 3 years, if you're planning to start your own practice and leaving the job role, you can clear the examination today itself. And once you leave the job, thereafter you can get yourself registered. But in 3 years, if you don't get registered as a member, then that past examination will be lapsed.
As far as the topical questions are concerned, the first question that we have is, in case of issuance of debentures, can a company provide security of third parties which are related parties but not associate, subsidiary or holding companies? For example, partnership firms or companies which have common directors.
Okay, so when a company is issuing debentures and you need somebody to guarantee the debenture holders that if company is not making payment, we will make payment. This has nothing to do with the valuation part. I mean, that is a totally different thing. So if you're issuing non-convertible debentures, you don't have to get done the valuation. NCDs, you don't require valuation. Even for CCDs and OCDs, compulsory convertible debentures and optionally convertible debentures, If any kind of guarantee is offered, it has again nothing to do with the valuation.
For valuation of immovable property provided as security, is valuation report from registered valuer required?
Yeah, there is a point which I'm going to cover in one of the next slides, but allow me to discuss it here. So acceptance of deposit rules. They have in the rules definition of deposit is given, and it says if if your debentures are unsecured, these are treated as deposit. But if the debentures are secured, it is not treated as deposit. But there are several conditions, and one of the conditions is that the fair value of the security should be more than the value of the debenture. So if debentures are worth 100 crore rupees, the fair value of the immovable property which is charged should be more than 100 crore rupees. Now the question is, how do we know that what is the fair value of the immovable property which is charged to secure debentures? So that securities must be valued by a registered valuer. If it is an immovable property like land and building, that I cannot value. I am SFA category valuer. So any land and building valuer will make valuation of it. But suppose your company has made investment into some other company. It has obtained 5% shares in other company, maybe unlisted company. And those shares are charged to secure debentures. So now you'll have to get done valuation of that security, which is offered as a charge. Now I will do valuation of that security, and this must be done by the registered value. Sometimes, now there is one confusion, I'll tell you. When you try to get valuation of land and building, there is one more category of registered valuers who are not IBBI registered valuer, but who are valuers registered under the Wealth Tax Act to do valuation under Income Tax Act. So beware of this particular thing, that if you are getting done valuation from a land and building or plant and machinery valuer, that fellow should be registered with IBBI. May or may not be under Wealth Tax Act, that hardly matters, but must be registered with IBBI.
For valuation of securities, whether goodwill is counted?
Now the question is, do we need to sometimes make valuation of securities which is like goodwill? So I'll tell you, there is one such situation where we do make valuation. What happens? Business combination. So there is a company A Limited which has acquired another company which is B Limited, and by paying some purchase consideration of say 30 crore rupees, I pay 30 crore rupees, I acquire another company. When I acquire another company, the book value of the assets I have obtained is only 5 crore rupees, while I am actually paying 30 crore rupees. Now I'll have to make journal entry of this 30 crore rupees. Suppose I am paying 30 crore rupees cash. So my bank account is created for sure. Now what to debit? So there are various assets which I am obtaining due to this business combination. So first, fair value of each tangible asset is calculated. Then fair value of intangible assets such as the brand, trademark, customer relationship, which is called identifiable intangible assets, is made. So I do valuation of all those intangible assets. So fair value of tangible assets is say 10 crores. Fair value of intangible assets which I can identify is 5 crores. That is 15 crores. But I have paid 30 crore rupees. So that balancing 15 crore rupees is treated as goodwill. This is one situation where goodwill is valued by the registered valuer. Another, this is under Ind AS, Ind AS 103 for business combinations. Another situation is impairment testing. Once you debit this goodwill into your books of accounts, it will be part of your balance sheet. Now, every year you will have to make valuation of this goodwill, because goodwill you don't depreciate, you only impair it. You can't say 15 crore goodwill is there, next 10 years I'll write off 1.5 crore each year in my P&L. No. Every year you will have to appoint registered valuer. He will do impairment testing for that goodwill. And if he finds that goodwill is not worth 15 crore anymore, he will certify it is worth 10 crore, and you will have to take a hit of 5 crore rupees on your P&L. So 3 months ago, I was doing valuation for such big listed company, and the goodwill sitting in their balance sheet was roughly 150 crore rupees. And when I made valuation, the fair value was coming hardly around, 100 crore rupees. Now that means they need to write off 50 crore rupees of goodwill as an impairment loss. This is the situation when the goodwill impairment testing is done, and for that you need to make valuation of goodwill.
But that would appreciate also in some cases.
But appreciation is not considered. Only impairment is considered under Ind AS.
And talking of Ind AS, how to compute ESOP's cost as per Ind AS 102, and who can do the evaluation? Who can do the valuation?
Okay, now this is an interesting question. Who can do the valuation? People, when you read section 247, it clearly says that whenever any valuation is required under Companies Act, it can be done only by registered valuer. Now, people have a misconception. They think whenever any report is to be filed with any statutory authority, only that valuation should be done by registered valuer, and any valuation which is obtained and kept with the company, not filed anywhere, may be done by anybody, even by the practicing chartered accountants or maybe some other people, merchant bankers. Now, that's a misconception. Because, see, like this example of goodwill impairment testing I was giving. So, once I give my report to the company, they are not going to file it with anybody. They will simply show it to the auditor. In fact, auditors only initiate it. Looks like your goodwill, get done the impairment testing by some independent person. If they ask board of director, is your goodwill impaired? They will never say it is impaired. So they will say that go to an independent person. So they came to me, I did the valuation, I gave them the report. Auditor may even challenge it that no, I don't think so. The value is that much high. It may be lower. We can discuss it further. And then it will be filed with the company only. I mean, it will sit in the company's file only. It will not be filed anywhere. Now, this gives an interpretation to the people that you obtain report from anybody. But that's wrong, because if you're getting done evaluation under Ind AS, how come Ind AS into role? Section 133 of Companies Act says that government will specify accounting standards to be followed. And then the Ind AS rules says that you need to follow these Ind AS. So if you are actually complying with Ind AS, means you are complying with 133 section. And as per section 247, any valuation under this act must be done by registered valuer. So all the Ind AS valuations must be done by the registered valuer. This is one thing. Now, the second part of the question, who can do valuation for ESOP? Must be done by the registered valuer. No one else should do it. Second is, how do you do the valuation? So the thing is, ESOPs are, there is something, ESOP is actually an option. F&O trading happens in the market, futures and option. That option is there. And when you attend the valuation course, you will learn that for valuation of options, there is a model which is called the Black-Scholes option pricing model. A complex formula is there. You need to run that formula, and that's how you arrive at the value of the option. Mostly in case of startups, I'll tell you one simple thing. Broadly, the startup share price are 15,000 rupees per share, 20,000 rupees per share, and ESOP is mostly allotted at par. So a share worth rupees 15,000, you have right to buy at 10 rupees. That means 14,990 rupees is the value of ESOP. This is called intrinsic value of option, and mostly this is the fair value also. So once you calculate that the option is worth 14,990, then this 14,990 is written off over the vesting period in the profit and loss account. If there are any questions on what I answered, suppose you asked a question, I answered it, maybe you have a follow-up question, feel free to put it into the chat box and I'll get it. Yes, please.
If the shares are transferred by way of gift, where the valuation is required, or it can be transferred on face value for a private company.
Okay, now this is again an interesting question. So when you are making transfer of shares, company is not affected at all. Neither the asset side nor the liability side of the company's balance sheet is affected by your transfer of shares. So when you transfer shares, no valuation is required under the Companies Act. Not at all. Even as of today, I keep getting inquiries that okay, we are transferring share. Can you make valuation? So I educate them. I say that look, under Companies Act, you don't need a valuation. Now the question is under Income Tax Act. So under Income Tax Act, what happens that Income Tax Act says that if I'm selling shares to you, then whatever sale proceed is there, that will be used to calculate the capital gain income in my hand. I'm selling share. I was holding it say for last 4 years, 3 years, 2 years, 6 months. And when I sell shares, there will be capital gain or loss in my hands. So that is dealt by section 50CA of the Income Tax Act 1961. And you are the buyer of the share. So this transaction may be taxable in your hands also as a gift under section 56 to 10, 56 subsection 2 clause 10 of the Income Tax Act 1961. I'll give you a very simple example. Suppose the fair value of a share is 500 rupees and I transfer it to you for 400 rupees. Fair value is 500, but I sell it to you at 400. Income tax authorities will say, look, Tarun, even if you sold it for 400 rupees, we will assume that you sold it for 500 rupees. Accordingly, they will tax Tarun. Now, as far as you are concerned, they will say, look, something worth 500 rupees. You got it for 400 rupees. So this 100 rupees is kind of a gift. And if it is not from a relative, then it is taxable in your hands. This 100 rupees. So in the question, is the question mentioning that it is a transfer to relative?
No.
Can you reach it? No. Okay. So in that case, it is advisable. Now the question is, what is fair value under Income Tax Act? So Income Tax Act says that this discounted cash flow model and everything will not apply. There is rule number 11 UA under this income tax rules. And rule number 11 UA is mostly based on book value. Mostly what I'm using, not completely. Mostly it is based on book value. And they have given a formula A plus B plus C plus D minus L. You need to religiously follow that formula and calculate the fair value. You can't apply your mind, follow the formula as it is. But a question, so to apply the formula, do I need to obtain the valuation report as per the formula from a registered valuer? The answer is no and yes. Income Tax Act is not saying that you obtain the valuation report as per the formula for transfer of shares. No, not at all. But practically, the assessing officers tend to challenge it. Ki, how do you arrive at this value? Maybe you have done some wrong calculations. So better you get it certified. Earlier, people used to get it certified from the auditor himself or from a chartered accountant. Now, people are getting it certified by a registered will. As nobody's certification is required, hence the anybody can do it. When it comes to anybody can do it, so the most eligible person to do valuation is valuer. So nowadays, under Income Tax Act, for transfer of shares, people are obtaining a valuation report, but that is as per the formula given in Rule U11 UA of the income tax rules. You don't have a control. People come to me and they say, somehow you arrive at a lower value so that I can save on the capital gain tax. I say it's not possible. Otherwise, also, I don't do anything like somehow. But in this case, even if you go to anybody, it's not possible because it is formula based. You have to feed figures from the audited balance sheet. So if you manipulate audited balance sheet, that's a different story. But otherwise, there is no chance. And as a seller, you will have to, have capital gain tax on that.
Moving to the next one. What if a company obtains valuation of merchant banker and registered valuer together and both valuation differs? Which report will have more weightage?
Now, this is again a very interesting and practical question, I must say. So there is one good thing which happened is in the last budget, which was announced in July 2024, a section was removed from Income Tax Act, which was popularly known as angel tax, and the section was 56 to 7b, section 56 subsection 2 clause 7b, which used to say it is no more. Now, many people are confused that this will be removed from 1st April 25. No, no, no. It has been removed from 1st April 24. Number one. When this section was there, it used to say if a company is making allotment of equity shares at a premium, at par it's fine. If it is making allotment at premium, then anything the company receives above the fair value is taxable in the hands of company. So par value is 10 rupees, fair value is suppose 500 rupees. Company, if it is issues at 600 rupees, then 100 rupees is taxable income in the hands of company. That was angel tax. And when company make allotment, it needs a valuation report from registered valuer. So there could have been a theoretical situation. You go to the registered valuer, sir, we are making allotment at premium, make valuation as per Companies Act. And valuer says that, okay, the valuation is suppose 700 rupees per share. Now, under the Companies Act, you cannot make allotment below 700 rupees per share. Okay. Then you go to the merchant banker and he certifies that the value is 500 rupees per share. Now, income tax authorities will assume that the fair value is 500. Under Income Tax Act, they will not think about whatever is certified by the registered valuer. They will only accept whatever is certified by the merchant banker. But the problem is you cannot allot shares below 700 because the registered valuer has certified 700. And if you allot at 700, while the fair value as per Income Tax Act is only 600, as certified by the merchant banker, 100 rupees becomes taxable in your hand. That's the big problem. Either you pay the tax unnecessarily, or you suffer under the Companies Act that ROC may reject your form and even the allotment. But practically that never happened, because see what happens that people usually find a group, like even people come to me as a registered valuer and they ask, do you know some merchant banker? I say, yeah, we work in association. It doesn't mean that we copy paste, but they give data to me, they give data to the merchant banker also, we give report to the company. And if there is any, mismatch in the value, then we will discuss with each other that where it has, gone wrong, and we try to reconcile it. So usually this is the case. You come to a registered valuer, he'll introduce a merchant banker, or you go to a merchant banker, he will introduce a registered valuer, and then they try to reconcile the values with each other so that this type of conflict may be avoided. But that never means that one body will do the work, another will copy and paste it. No. The two people will do the work independently.
Fair enough. So can a company offer issue to VC on discounted valuation as part of its strategy to attract investment?
Yeah, that was the case. I have given that example myself, that if you go for the unpriced, no, okay. So let's create two scenarios now to answer this question. Scenario number one, you go to the VC or to the angel investor, and so far you have not get done the valuation of your company. You are not sure what is value of your company. So you go for the unpriced funding round and you say, in 2 years, 3 years, whenever I go for the price funding, I'll give you discount, 30% discount as compared to the price prevailing at that time. That's absolutely fine. Very much allowed under the Companies Act. But the other way around. So suppose after 3 years, you make valuation and the fair value is 1,000 rupees. And to some individual investor, you are issuing at 1,000, and to the VC you are saying, sir, today only you give me money and I'll allot you at 700. You cannot issue shares below the fair value certified by registered valuer. Reverse is allowed. Let's put it in other words. Fair value is 700 rupees per share, and you are making allotment to VC at 700 rupees per share, while to some foreign investors in the same funding round you are allotting shares at 1,200 rupees per share, or maybe after 15-30 days you're allotting it 1,200 per share. So above fair value, I mean, differential pricing is allowed. To one investor you are giving at fair value, to other investor you are giving above fair value. That's absolutely allowed. But allotting to one at fair value and allotting to other below fair value, rule 13 sub rule 3 will not allow that.
I guess we've discussed this one partly. If a company is coming with a right issue in which shares will be renounced in favor of 4 persons by rest 12 persons, then will valuation be required under Companies Act and Income Tax Act? We discussed this thing, I guess.
Yes. So under Companies Act, valuation will not be required because renunciation never requires any. Renunciation is like transfer of share indirectly. So you don't need it. But under Income Tax Act, it may be required. That will be as per the formula, because for that you will have to make valuation of share as per Rule 11 UA formula. Then that can be done. That rest of the people, they are renouncing their right to one shareholder or a group of shareholder. Under Companies Act, you don't need a valuation. But keep in mind, when you renounce the right, and valuation will be required under Income Tax Act, number one, and whatever money is received due to this renunciation of right will be actually taxable in the hands of people who are transferring their right. So if it is a part of some money, you need to be careful. If it is a genuine transaction and they are ready to pay tax for it, that's fine.
How is consideration calculated when there is interstate transfer of shares between the promoters in an off-market transaction?
So that is again under the Income Tax Act. If it is a listed company, they say if it is a listed company and you are transferring share in the market itself through the share broker, then whatever actual transfer price is there is treated as consideration. But suppose share is listed and you are trading off the market, you are dealing off the market. One promoter is transferring his share to another promoter, though the share is listed. So then you look at the stock exchange price of that day. That, okay, today's price, I think some minimum or maximum price is there. If you give me a minute, a sec, I'll just double check it and I'll tell you. Give me a moment for that. So under income tax rules, it is Rule 11 UA. That day's price is taken, but whether the minimum one, maximum one, or the closing price, I'll just tell you. Fair market lowest price of such share. So today on 8th of January, just my videos are lost. Wait a minute. Okay, I got it. So suppose today on 8th of January, we two are promoters. Share is already listed. I'm transferring share to you. In that case, today throughout the day, the trading happened. Whatever is the lowest price, stock exchange declare 4 prices: lowest price, highest price, opening price, and the closing price. Whatever is the lowest traded price will be treated as consideration. Actual consideration may be more than that, maybe less than that. For tax purposes, that will be treated as the consideration. But what if the company is unlisted and promoters are transferring shares? In that case, that book value formula, A plus B plus C plus D minus L, where immovable properties are taken at the stamp duty valuation and all other properties are taken at the book value, and that value is calculated. In fact, I got this inquiry, last week only, that our book value per share is 1,300 rupees and we want to transfer share at 100 rupees. How can we save tax? I said not possible. Because if book value is 1,300, then as per income tax act, your consideration will be treated as 1,300 only, even if you say we transferred it for zero.
Damn. So can a company issue CCPS shares at face value without taking valuation report, even though earlier round of investment has happened with valuation report?
No, not at all. Because,
Not
but
actually.
I'll take big my words. Not rather than saying not at all, I'll say first we need to check is the CCPS 1:1. Mostly CCPS are 1:1 convertible. If it is 1:1 convertible CCPS, that means you have decided the conversion ratio and you must obtain a valuation report. But if this round of CCPS says that the conversion will happen at a price at the time of conversion, then you can simply obtain a compliance report today and file it with the ROC. You don't have to obtain the valuation report. But I guess if previous round was with at 1:1, then this round must also be at 1:1 conversion ratio. Then you must obtain the valuation report.
As per the new SEBI guidelines, the merchant bankers are not allowed to do the valuation of shares of the company. However, the Income Tax Act requires that it be done by merchant bankers.
Actually, the guidelines are not yet issued, but SEBI has two things are happening nowadays. If you go today and try to obtain a merchant banking license with SEBI, then they are giving kind of an advance warning that look, if you are getting registered as a merchant banker because you want to give valuation service, be aware in the time to come it will be totally stopped. And even as of today, the SEBI has a concern that you are into merchant banking business. Why are you doing valuation? So, but there is no such guideline which has been issued and which has been, implemented. In the time to come, we will see SEBI guidelines which will clearly say that if a merchant banker wants to do valuation, they should register a separate entity, which is VPE, Valuation Professional Entity. For that, you need to be registered value. Merchant banker cannot register it. Only registered valuers can get it registered. But as of now, they are doing valuation. I am obtaining valuation from merchant bankers. We are filing it at various places. As of now, they are doing valuation. Angel tax, one of the big business of merchant bankers was making valuation for allotment of shares at a premium. That is already gone from July 2024. And other valuations which merchant bankers are currently doing, SEBI is concerned about it, that they should not do it. But as of today, they are not prohibited. In the time to come, that's a good concern, in fact. In the time to come, once they prohibit merchant banker from doing valuation, they must amend Income Tax Act and say that registered valuer can do the valuation. It is a long pending demand of registered valuers that you have created a new profession, that you guys are specialists of valuation and you are not allowing it under the Income Tax Act. In fact, I was part of one of the committees set up by Ministry of Finance, Government of India, for uniform valuation of equity in India. And our committee, we studied all the acts and we came to a conclusion that different acts are requiring different people to be the valuer. Under FAMA, chartered accountant, cost accountant, merchant banker can do valuation. Under Income Tax Act, registered valuer. Under Companies Act, registered valuer. Under Income Tax Act, merchant banker. Some other act are requiring some other things. Why don't you say that if for a single transaction, I have seen that company obtaining 3 reports, one from merchant banker, one from registered valuer, one from chartered accountant. For a single transaction, I have seen that. So we gave the report to the government that the registered valuer, if company is obtaining a report under Companies Act, that should be acceptable under the Income Tax Act also. So far, the amendments are not done. We are hopeful it will be done in the time to come.
Before moving to your presentation, one last question. What
Yes,
is the validity of valuation report obtained for preferential issue, and can it be used for subsequent private placement?
Now that is again an interesting and practical question. Under Reserve Bank of India Act, when you obtain a valuation report for FAMA, they say the validity period is 90 days. That's roughly 3 months. But under Companies Act, they have not specified any time limit. So Practically, I advise people that at most 6 months, you should obtain a fresh valuation report. And on an average, I recommend 3 months is also a good period. That suppose you obtained a valuation report. Now there are four dates related to valuation. One is the valuation date, that I need valuation as on 31st December 2024. I'll tell you the sequence. So, suppose today a company comes to me and says we want to make preferential allotment. So, I say them try to have the latest valuation date. Don't say that today you're obtaining the valuation report and let's value as at 30th September 24 or 31st March 24. Don't do that. Take the latest date. But the problem is that when you, whatever valuation date you decide, you need to give me management signed balance sheet as on that date. Besides the discounted cash flow method, I need balance sheet as on the date of valuation. So when I say management give me balance sheet on 8th of January, they become uncomfortable. 8th of January balance sheet, how can we give you today? So we'll be able to give you 31st December or maybe 30th November. Month end kind of thing happens. So they come to me today. Today they give me an appointment. So date of appointment is 8th of January. Maybe tomorrow I'll issue them an engagement letter that these are my terms and conditions. That my report will be kept confidential, XYZ, all those things. 8th of January is my appointment date. 9th of January is the engagement date. Date of valuation is 31st December 2024. And maybe I'll give you a signed report on 21st January. So date of signing is 21st January. Say, for example. Now, four dates are involved. 31st December valuation date, 8th January appointment date, 9th January maybe engagement date, the two may be same also, and 21st January is the signing date. So you don't count it from the signing date, you should count it from the valuation date. 31st December was your valuation date. Now in the month of April, again, if you're making allotment, I'll say better you obtain the report once more, which will be like 31st March 2025 dated valuation. Usually 3 months or happening of an event, material event, whichever is earlier. I'll tell you one thing, something interesting. Valuation is not date specific. In fact, it is time specific also sometimes. So I issue a report where I say, suppose valuation at 11 a.m. on 1st of January. It means I have considered all the events up to that point of time. Mm. And at 12 noon, something tragic happens with the company, which kind of collapses the company. Now that valuation is no more valid. It is all gone. Valuation is not only date specific, but also time specific. But itana detail mein to we don't go time thing, but 3 months or a material event, whichever is earlier, your valuation report kind of expires and better to obtain a new one. But 3 months is not written anywhere. It is a practice.
And sir, over to you for your presentation.
Right. In fact, this is the more interesting part where we can, connect with the participants and keep asking questions. All my colleagues over there who are listening, and keep sharing your own experiences also. That will make the session more fruitful.
Some of the things have already been covered regarding rights issue and all. There are quite some questions which have come again.
Right. We can skip that. Right. Not a problem. Okay, so far we discussed about section 62, which is the most prominent section for valuation. We discussed about it. Now, a practical problem, I'll tell you. People come to me and one more question remains. Do I need a valuation for buyback? Though I'll cover it later also, but let me answer it here. When you read section number 68 of Companies Act, nowhere it is written that you need to obtain a valuation report. But when you read the buyback rules, the board of directors need to decide the price at which they want to do the buyback. Now, many ROCs, whatever forms you file, I don't practice as I just practice valuation. So some SH7, SH8 forms are filed. I'm not really sure. Some forms are filed with ROC when you do buyback of securities, and some of the ROCs started asking questions that where is the valuation. So it happened to me, in fact, 2-3 years ago, that somebody came, sir, we need a valuation for buyback. So I prefer to educate people that, see, you don't need a valuation. Still, if you want it voluntarily, I'll happily do it. But you don't want it statutorily. They said, no, no, actually, we also were thinking, but ROC has raised a question. Where is the valuation report? So some of the ROCs, they tend to ask valuation report even for buyback of securities. And okay, even if ROC is not asking, then the duty is on the board of directors to arrive at a fair price. And tomorrow anybody can raise a finger. If there are, see, if it is wholly financed with your family money, that's fine. But even if a single investor is there, he can raise a concern that how did you arrive at this price? So board of directors, especially if there is any independent director in your company, they would not like to take any blame. So they tend to say, for every single thing, go get done the valuation. We don't want to, why should we decide it? Let the independent person do it. So even for buyback, people come to me and they say, look, sir, if we do buyback at a higher price, it is now deemed dividend. Now the buyback tax provision has changed crazily in this last budget. What the government has said now, that suppose 10 rupees face value share, if you buy back at 2000 rupees, from whom? From Tarun Mahajan. Tarun Mahajan was shareholder. Tarun Mahajan obtained this share for 1500 rupees from the market. And now there is a buyback offer at 2000 rupees, and Tarun Mahajan gives the share at and receive 2000 rupees. The tax law is saying entire 2000 rupees is taxable in the hands of Tarun Mahajan as deemed dividend income. Forget about the acquisition price of 1500 rupees. And that 1500 rupees is kind of, a capital loss, which you can carry forward and then you can set off if you have any capital gain. So that's why in July this was announced, and they said it will be applicable from 1st of October. So July to September, our country see lot of buybacks. Everybody, whosoever wanted to, siphon out money from company, excess money, they used this route of buyback, because buyback was earlier taxable at a favorable rate of roughly 22.23-22% roughly. And deemed dividend income will be taxed at my slab, and suppose my slab is 35%, including surcharges. That is quite expensive. So I was telling you, people come to me and they say, look, sir, we need a valuation. I say, okay, do it. And do it as per the book value method. That book value per share you calculate and you certify it as the value. So then I need to educate them that, look, sir, you can appoint a valuer, but you cannot dictate him the method of valuation. It is the absolute discretion and pure duty of the valuer. As a valuer, see, all data is provided to me by the company. Forecasted next 5 years P&L balance sheet, cash flow statement, company will give me. Historical P&L balance sheet, cash flow statement, company will give me. All other information company will give me. 100% data is obtained from company. Then what do I do as a valuer? I choose the right method and apply it. That's what the job of the valuer is. So you can't snatch my job that do as per the book value method. So never ever encourage any of your clients to do this to the valuer. There are 3 approaches of valuation. I'll tell you. One is called the income approach, which is based on the future earning capability of the company. One is called the market approach, which is based on the current market multiples. And one is the cost approach. Under these 3 approaches, there are many methods. So the most popular valuation approach method under income approach is discounted cash flow method. There are many more methods: multi-period excess earning method, relief from royalty method, option pricing method, but the most popular one is discounted cash flow method. Under market approach, usually we do market multiple, like price to earning ratio kind of ratios we use. And cost approach is the least preferable approach, where you calculate. That is again not book value approach. People have a misconception: cost approach means the book value. No, no. Cost approach means the replacement cost. That if I try to replace this asset with a new asset from the market, what will be the cost of individual asset, and then sum total of all those assets is the cost approach. The question is, see, you might be thinking, why should I know this as a company secretary if I simply have to obtain a report and file it with? No, you should be aware about it. Maybe the valuer is doing something wrong, or maybe you are trying to get done something wrong from the valuer, having an impression that this is right. So these three approaches are there, and it is the duty of valuer to consider all three approaches. I'm not saying to use all three approaches. I'm not saying. I'm saying to consider all three approaches. It is the duty of registered valuer to consider all the three approaches, and then he may reject it. Okay, this is a startup and they are generating some revenue and profit. Cost approach is not suitable. I reject it. Market approach is suitable. I'll use it. Income approach is suitable. I'll use it. And I'll give 50% weightage to the values obtained by these two methods to arrive at the average value. I have been seeing that many listed companies, they make preferential allotment of equity shares to selected investors. In that case, the valuation report is filed with the stock exchange also. And NSE is aggressively sending letters, even the BSE. But what I have heard many of the cases from NSE is aggressively sending letters to the companies, asking many questions on valuation. So gone are the days when valuation report once filed is done. Nowadays, SEBI is asking questions on valuation report. NSE is asking questions on valuation report, and many other agencies. So NSE is asking question that why you have not considered all three methods. You must consider and explain. I accepted, this is why. I rejected, that's the reason. And even if you are using all three approaches, then what weight to give? Because now if you're using three methods, three approaches, you are having three different values. Which one is the final? So you tend to take the weighted average. So NSE is even asking, see, how much weight to give? It is purely the decision of valuer based on his professional judgment, his experience. If a company is flourishing with a lot of income, then cost approach is not really important. Market approach I'm not using because I don't find comparable companies. My business is very unique. So I'm using only income approach and giving 100% weightage to it. So even I'm getting questions from the authorities that why you have chosen these weights. So there must be some solid reasons behind it. So when people approach the valuer saying that, sir, chalta hai, it's all right, fine, you do it on the book value is not a method, and let the valuer choose the approach and method of valuation. So is it necessary to consider all approaches? Yes, consider. But using all approaches is not necessary. You may reject and you may select. You can have more than one approaches. You can have more than one methods under a single approach, and then you can assign suitable weights to each of the valuation obtained. Now, so far we were talking about unlisted companies. Now let's talk about the listed company. If a listed company is making preferential allotment of its equity share, do they need valuation? Answer is yes, if the share of the company is infrequently traded. Because if the share is infrequently traded, price discovered by the market is not a reliable price. So valuation is required even in case of listed company if its shares are not frequently traded. Now, what do you mean by frequently traded? or infrequently traded. Infrequently traded means number of shares traded in last 240 trading days. Now, sometimes people even commit a mistake over here also. Last 240 days are less than 10% of the total number of shares of that class. So suppose issued capital of the company is 5 crore number of equity shares. 10% of 5 crore number of equity shares is 50 lakh. So in last 240 days, 50 lakh number of shares, if not traded, then your share is infrequently traded. It is not 240 days, it is 240 working days. It is not 240 days on which your share was traded. It is 240 days on which stock exchange was working. In one such case, it happened. The share was infrequently traded. So 240 days happened in last 1.5 years. In last 1.5 years, 240 days were there in which trading happened. So valuer did valuation, considered that. So then the stock exchange said, no, 240, when we say it means 240 working days of the stock exchange. Whether your share was traded or not traded, we don't consider that for counting number of days. So if less than 10% shares are traded, your share is infrequently traded. Infrequently traded means go and obtain a valuation report from the registered valuer, and only after that the listed company can make preferential allotment of equity shares. What if my shares are listed on more than one stock exchanges? So here we will take the stock exchange where the trading volume is higher in last 90 trading days. I'm listed on both BSE and NSE. My volume is more on, say, BSE. In that case, I'll not consider NSE volume, I'll consider BSE volume. Next question is, what if the company is listed and frequently traded and it is making preferential allotment of equity shares? Do I need a valuation? So the answer is yes, but earlier it was not required from registered valuer. SEBI simply gave a formula. You follow the formula and make your own valuation. Because company is listed, price is already discovered in the market. You don't need an expert. Now, market is more reliable than what the expert is saying. So, in case of listed company, frequent trading and making preferential allotment, 90 trading days, volume weighted average price you calculate. Earlier, it was very complicated calculation. But last 2 years, it has been made very simple. And 10 trading days, volume weighted average price, whichever is higher is the floor price. You can issue at or above it. So 90 trading days, weighted average price is suppose 500 rupees and last 10 days price is suppose 700 rupees average. So 700 rupees becomes your floor price. You can make preferential allotment at or above 700 rupees.
I have a question which I just saw in this. What is the practical reason behind giving these two options, 90 and 10?
Okay, so this is the thing. 90 days is capturing a comparatively longer term trend and 10 days is capturing a short term trend. Even the people who do technical analysis, that is chart study, and based on that they buy and sell shares, they also calculate two different periods moving averages. And whenever a crossover happens in these two moving averages, they tend to buy or sell it. So it is like, even if some speculation is there in last 10 days, SEBI wants to make it sure that, see, the whole purpose of this valuation exercise is share should not be issued at a lower price, because if you are issuing share at a lower price, existing shareholders are at a loss. That's why, to capture the trend. But why? Because earlier it used to be 240 days and probably 60 days. But maybe the SEBI studies might have shown that you don't need that long period to capture the trend of the price. This is the average. See, income tax rate is saying on the day of trading, whatever price is there will be considered as transfer price. They are not even taking the average. But SEBI guidelines are taking an average because there may be some speculations and which can unnecessarily cause a hardship to the company. That's why they are taking an average. Then there happened one interesting thing which changed the SEBI guideline, which was the case of PNB Housing Finance. So in PNB Housing Finance case, what happened? They calculated these two averages, and whichever is higher was like 450 rupees per share. PNB Housing Finance, it was probably 2021 story, year 2021. So PNB Housing Finance market capitalization was roughly 6,000 crore rupees. They were getting a funding from Carlyle Group, private equity investor, of 4,000 crore rupees. Huge amount, right? That was a preferential allotment. So now you need these two checks. As per these two checks, the price came at 450 rupees. So PNB Housing Finance said, okay, we'll give them shares at 450 rupees per share. After this announcement, somewhere in May, the price actually went up to 700 rupees per share. That, okay, Carlyle Group is coming and they will be in the controlling position. It's no more like the PSU type run company. It will be the privately owned type of company. But unfortunately, the article of association of PNB Housing Finance was saying that if you're making preferential allotment of equity shares, you must obtain valuation report from registered valuer. I am just trying to guess it. When Companies Act 2013 came, almost all companies changed thereafter their article of association. So many companies simply copied and pasted contents of table F. Probably they might have done it, ignoring that being a listed company, they don't need valuation certificate from registered valuer. Probably it was copied and pasted. Once it was pasted, it is part of article of association now. So some of the, what do you call them, proxy management people who give advice to institutional investor where to vote, where to not to vote. Some of the companies, they went to SEBI and they said that you should stop this private placement because the company is in violation and it has not obtained valuation. See, at that point of time, if PNB Finance would have come to me and asked me that, Tarun, make the valuation, I would never have certified 450 rupees as value because there is something which is called control premium. I'm obtaining 100 shares of the company, it is available at 450 rupees. I'm obtaining 2 crore shares in the company. I'll start controlling the company partially in many of the crucial decisions. So in that case, I will be able to obtain it at a premium, not at 450 rupees, maybe 40-50% premium I'll have to pay for it. If you obtain minority interest, it is available at the traded price in the market. If you're trying to obtain controlling interest, it must have some control premium. So even if on that day PNB Housing Finance would have asked me to make the valuation, I would never have certified 450 rupees. I must have certified some 600, 700 rupees. And if registered valuers certify 700 rupees, they won't be able to make allotment at 450 and the whole deal, will be get cancelled. So the group of investors went to SEBI. SEBI stopped it, this allotment. Then they went to Securities Appellate Tribunal, the company, and they lost the case over there. Then they went to NCLAT and then they lost over there. And then they went to Supreme Court and finally they won the situation. So that was kind of big hassle for them. Eventually they could make allotment at 450, but thereafter the SEBI guidelines were changed, saying that if your article of association, how the company actually won the case, they said we are complying with the SEBI guidelines, so we don't have to comply with article. And this was accepted by the Supreme Court. So if there is a contradiction between our article and the law, then act is superior, law is superior. So kind of we don't have to comply with article. Kind of smart move they made it. And they are big companies, they must have hired big lawyers, so they could convince the judge. Now the thing is, thereafter SEBI guideline itself changed. And SEBI said, if you are a listed company, frequently traded, but your article says that valuation from registered valuer, then you will have to obtain that also. And this price or the price decided by registered valuer, whichever is higher becomes your floor price. So this is the situation now. Even in listed company, check the article, or you change the article first before you go for the preferential allotment. And if registered valuer is written over there, you will have to obtain valuation certificate. Now, on the top of it, they have also said that in the takeover regulations, that even here, some 5%, if you're obtaining more than 5%, I just forgot that cutoff number, more than 5% shares in the company, if you're obtaining, then in that situation also, even if the article is silent, in a listed company, you will have to obtain valuation report from the registered valuer. So that's the situation. Now even the listed companies are indirectly, directly needing a valuation report from the registered valuer. Registered valuer can also consider market price as one of the approaches, but he will also consider, he'll have to also think about other approaches of valuation. This is about section allotment of shares section, all about that particular section. So do we have more questions now, or should I proceed?
I do have some questions, but let's be done with the PPT first and then we'll...
Okay, perfect.
Given the time, I guess we'll...
Right. For sure. Even if some of the questions come to the mind of the participant later, my name is Tarun Mahajan. You can simply Google me. Google knows me very well. It will lend you to my website where you can get my contact details, and you can WhatsApp your queries anytime to me. I'll be more than happy to answer any of your questions, even after the session. Okay, so look at this. 133, we have already discussed this, that whatever valuations are required, see, under Ind AS, most of the things are at fair value. So if you are making investment in other companies, that should be at fair value. You have issued convertible securities, OCDs, OCPS, your liability side of balance sheet. That also requires a valuation under Ind AS. You need to show it at the fair value, not at the issue price. Then when you acquire any business for, business combination, merger is there, all the assets are to be stated at fair value. Impairment testing of many assets are done regularly to bring them at the fair value. So many things under Ind AS are stated at fair value, and that fair value valuation must be done by the registered valuer. Let me tell you, if you ask me that, Tarun, as a valuer, what do you enjoy most? I'll say Ind AS valuations. Because IBC valuation as SFA valuer, I kind of don't do it. I don't need skills because the company is already lost. And what is sitting in the balance sheet? Some receivables, most of them are non-recoverable, some short-term loans and advances, cash and bank balance, full stop. That is what I have to look as a valuer. Until and unless lots of subsidiaries are there and some of the subsidiaries are doing very well, those are exceptional cases. In 95% of the cases of IBC, you don't need good skill set to do the valuation as SFA valuer. Land and building people have the role to play, because in all those lost companies, the only thing left is land and building, which is worthwhile. Under Companies Act, also the most challenging and most valuation which require a lot of skills are valuation for Ind AS. The depth of finance is actually used in these valuation. The Black-Scholes option pricing model, binomial option pricing model, Monte Carlo simulation, relief from royalty method, multi-period excess earning method, what not. Even in I need to apply the geometric Brownian motion concept on which the calculus formulas are derived. All those things you need to consider, and when you do valuation, and some big firms are auditor over there, some good firms are auditor over there, they don't take your valuations at par. They kind of challenge your every single assumption, that how do you take this assumption? What is the logic behind it? What is the data behind it? So that is the most challenging kind of valuation, because whatever value you give, the financial entries will be based on that valuation, and the whole financial statement will be reflected to the entire world based on that. So that requires gives you a lot of responsibility also. Okay, so some examples of Indies are impairment testing, intangible assets valuation, valuation of assets and liabilities which are carried at fair value through profit and loss and fair value through other comprehensive income, valuation of warrants and convertible securities. This is also an interesting thing. Adani Group of companies has been issuing, in many cases they are issuing these warrants. And SEBI guidelines with warrant means right to buy share. It is as simple as that. One simple thing is I give money, company give me share. This is allotment. Warrant means company gives me right to buy, option to buy share in the company. So SEBI guideline says that the maximum period for which warrant may be issued is 18 months, 1.5 years. But if company is unlisted, warrant may be for 5 years or 10 years also. Then the second thing the SEBI is saying is, if you're saying that you can buy share in the company in next 18 months at rupees 1,000 per share, which is the current fair value, then 25% of this should be received in advance. 250 rupees you receive today. If this buddy exercises to buy share, he'll give remaining 750 rupees and buy the share. If he chooses not to buy share, this 250 rupees per share will be forfeited as option premium. Now there are serious concerns over it, because I have raised this concern at various forums, but so far I have not, got any very satisfactory answers. SEBI has fixed 25%. That means there is a concept of option premium. If I go to the market today and I say I want to acquire option to buy Reliance Industries Limited share after 3 months. So to get this option, I need to pay some premium. And SEBI fixed this premium at 25% of the issue price, current market price. If the company's share is very volatile, writing option is like issuing an insurance policy. I'm a professional. If I obtain life insurance policy, that's a different thing. But what if I'm in BSF, Border Security Force? What if I'm in Army? What if I'm riding a bike in a death well? Right? So huge risk is there. Either I'll not get the life insurance policy or the premium will be huge. So this is how the thing. Some of the companies, their shares are very volatile. If the shares are very volatile, the option premium should be higher. Well, SEBI has given this permission to issue at 25%. So when companies issue warrant, again, the same thing is there. Whatever the fair value of the warrant is there, you can issue at that fair value or above that fair value. In one such case, if the company is not listed, the problems are even more. So what happens is 5 years time period to exercise the option. Only 10% is received as advance. I made valuation and 1,000 rupees share, you should have charged 400 rupees in advance, but they have charged only 100 rupees. Currently, there is no law regulating it. So companies are doing whatever they like to do this. This is kind of a loophole in the law, which is not clearly regulating warrants which are issued to the promoters, founders for buying shares in the company. So these also need actually evaluation under Ind AS. Corporate guarantee. So this is a regular practice. The subsidiary is borrowing money and holding has given the corporate guarantee. Now under Ind AS, they need to do accounting for this. Because if you give guarantee for a third party, then they'll give you guarantee premium. Okay, thank you for giving guarantee for us. This is your fees for giving the guarantee. In holding subsidiary transaction, they don't charge the fees actually, but for the purpose of accounting, they need to charge it. So for that, they need a valuation. Very complex valuation models are used for this. Purchase price allocation in ESOP, we have already discussed. Then, okay, this is not relevant. Buyback point we have already discussed that for buyback, ROCs are actually kind of asking valuation report, but there is one thing in where in the law itself it is written that you need valuation. Section 67, subsection 3, clause B. It says that public company cannot give loan to buy its own shares. But there is an exception that suppose there is a trust which is for the welfare of the employees and company is giving loan to this trust, and with this money if the trust is buying shares for the purpose of employees, then even the public company can give loan to buy its own shares. But in this case, a valuation report is required from registered valuer as per the act itself. 68 we have already talked. 73 we have already talked that secured debentures are not deposit, but the security should be sufficient. Whatever is charged as a security should be valued by the registered valuer. Then 192 section is simple section. If you are buying an asset from the director and issuing shares to him, you need a valuation report where two valuations will be required, one of the equity shares of the company and one of the item you are buying from the director. Or even if you are selling an asset to the director, again the same situation is there. And all these sections 232 236, that is really simple and clear. You see why? Because when you are doing the merger, you need an exchange ratio. For exchange ratio, you need to make valuation of both companies, acquiring company as well as target company, without considering the synergy which will arise due to merger. Make two independent valuations, and based on that, you need to give an exchange ratio. Valuer not only makes valuation but also suggests the exchange ratio, and that report will be filed with NCLT, which will finally give approval for the purpose of that merger. And then the last thing is for winding up of the company. So nowadays winding up are rarely done under the Companies Act. They are preferred under the IBC. So if you are getting done the winding up under IBC, you need a valuation report. Even if you are getting done the liquidation process under Companies Act, liquidator will appoint the valuer for making valuation of the assets of the company. So the world of valuation is, actually very exciting, and from the outside it looks like there is valuation mein kya hi hota hoga, but a lot of things are there which actually need valuation. Forget about all the legal requirements. For transaction purpose also, two brothers are getting separate, and then they come to me and they'll say, look, we want to get separated at fair value. I just want to leave this company. I don't have any, my son is not interested in doing business. His son is doing business. We want to get separated. At what price I should give them my shares? So many such transactional valuations are also done. And those are also really good valuations because you are not doing it for the purpose of, because the client is dependent on you. Whatever value you tell him, is going to bargain, negotiate on that basis. And in fact, in many cases, he makes you part of the negotiation meeting also. So that also becomes an interesting thing to do. So we'll take more questions, but later if you have any questions, my contact details are there. If you miss this contact details, you can simply Google, and feel free to connect to me on WhatsApp. I keep answering all the questions. I don't bother whether your number is saved with me or not. I'll answer your questions. Yes, ma'am, please.
We ended on winding up. So there was a question which was related to valuation of slump sale. How is it done?
Yes. So slump sale is like sale of a business unit. My company is doing three types of businesses. And one of those businesses, I think this is not my core strength. Why should I do it? I should sell this entire textile unit. I am into textile, I am into power generation, I am into sugar industry also. In one company, I am doing three businesses. One of the business is my textile unit and I want to sell it to someone else who can run it in a better way. This is like kind of informal demerger. It's not a demerger, but this is kind of that. So when a group of asset and liabilities is sold together, it's an income tax terminology. It is termed as slump sale. When you're making slump sale, the valuation is to be done as per the income tax act. Rule 11 UAE is there. And again, same book value based method is there. A plus B plus C plus D minus L. This is one. And then valuation of consideration in the same manner. There is a fixed formula. There are fixed things to be done under the income tax act, Rule 11 UAE, for the purpose of valuation for slump sale. But sometimes the client asks us that, okay, slump sale, through income tax formula, you decide a floor price that even if you are selling below it, tax authorities will assume this is your selling price. But you are free to sell above this, like stamp duty. You get registered a house and government, as per government rule, this plot is worth 2 crore rupees. You bought it for 4 crore rupees. You register it at 4 crore rupees and pay stamp duty accordingly. Nobody will stop you. So even in slump sale, clients sometimes ask us to do the DCF valuation, that what is the actual genuine fair value. One you do as per the income tax act, which says the value is 5 crore rupees, and otherwise the value is 7 crore rupees. So then they will prefer to sell it obviously at 7 crore rupees. So that is the voluntary thing which is asked by client. Legal requirement is only Rule 11 UAE valuation, which is mostly based on book value as per audited balance sheet.
I have three small questions. What is a forced transaction?
Okay, forced transaction is actually very general. Maybe it is in context that as a valuer, when I make valuation, there are two basis of valuation. One is as a going concern and one is under liquidation. When I do valuation, I have to first decide the basis. Am I doing valuation for a going concern or am I doing valuation for a situation of liquidation? In these two cases, the valuation approach changes. Under liquidation, then there are two further situations. One is orderly liquidation, where you get a proper time to market your asset, try to repackage it, try to sell it. And one is a forced liquidation or distressed liquidation, where you are in hurry, you want to quickly wrap up and you want to sell it. Maybe if you're asking in that context, so in that case, obviously the valuation will be on the lower side because you're trying to sell it quickly. And if you give it a proper market exposure and can repackage it, then valuation will be comparatively higher. Going concern valuation will be even further higher than that. If you have some other context, please let us know.
What is the difference between equity value and enterprise value?
That's again an interesting question. Equity value is the fair value of equity share. Enterprise value is fair value of all sources of finance taken together. Fair value of equity plus fair value of preference plus fair value of long-term debt plus fair value of short-term debt minus some surplus cash if you have, that gives you the enterprise value. So as a valuer, either we directly calculate the fair value of equity or we first calculate the enterprise value. And from enterprise value, then we deduct preference value, long-term debt value, short-term debt value. Then the balancing figure is fair value of equity.
Last question. What is participant specific value?
Now, that's again an interesting thing to ask. I'll tell you a sequence that when somebody asks me to do the valuation, what are the various things I have to decide and then write it in my report also. So what happens is, usually it starts with a phone call. Okay, Tarun, we want to get done a valuation. Will you do it? My first question, always irrespective of whatever you want to get done, what is the purpose of valuation? Until and unless I don't understand purpose of valuation, I can't do it. So some people say it is for sale of share, some for issue of share, for business combination, for family dispute, XYZ. First thing I need to know is purpose of valuation, and that must be written in my report also. Second, based on that, I decide basis of valuation, going concern or liquidation. Suppose going concern is my basis of valuation. Third, I decide premises of valuation, purpose of valuation. Second, I decide basis of valuation. Third, I decide premise of valuation. Base of valuation is going concern. Now there may be 2, 3, 4 premises of valuation. One is highest and best use of this asset. If it is made, what is the value? One is what is the value to Tarun Mahajan, to Umesh Trivedi, to Rakhi Jain? What is the value if he or she uses this asset? And third is the fair market value. Now these three things are different. Especially the participant specific value and the fair value. I'll give you one simple example, not a very high-fi one, but it will help you to understand better. There is a plot of land in a colony which is sold at 5,000 rupees per square feet. That's the market price in that vicinity. So a knowledgeable willing buyer and a knowledgeable willing seller, if they sit together and bargain, they will arrive at this price. Knowledgeable seller, knowledgeable buyer, nobody is a fool. Willing buyer, willing seller, nobody is forced. And now they are dealing, this price is the fair value. But what is the participant specific value? Suppose the seller comes to know that Tarun wants to buy it. Okay. Why Tarun wants to buy it? Because the house adjacent to this plot is of Tarun. They are a big family. They are finding their house to be small. They don't want to relocate. They don't want to split the family. They'll buy this plot and extend the house. Now, other buyers may be ready to pay 5,000, but maybe I'll be ready to pay some premium, 5,500 rupees. I'll pay. Because for me, it has some specific higher value. That's the participant specific value. But in as a valuer, mostly we don't calculate participant specific value. We calculate fair value. Both the buyers and sellers are knowledgeable, willing, and nobody has extra advantage and nobody has extra disadvantage to it. That's what the difference between fair value and participant specific value. So I'll repeat: purpose of valuation, basis of valuation, premises of valuation. Then we decide approach or approaches of valuation. Then we decide method or methods of valuation, and then we do the valuation. This is how it is done.
With that, we come to the conclusion of this first Master Knowledge Series webinar. And sir, I would like to extend my heartfelt gratitude and on behalf of all the participants for this interesting and intellectually stimulating session. We have all gained a lot today, a lot. And a big thank you and appreciation to all our participants as well, who have made this quite meaningful and successful. Thank you.
I would also like to thank you a lot because you kept asking questions very well, and you yourself were very, very keen while listening. I could see your video. That gives a lot of energy to any speaker, that there is somebody, you can see the face, who is listening with all the enthusiasm. So thank you very much, and thank you all the participants for asking such wonderful question and making the session live and meaningful. And as I said, I'm always available. It's not like this is the session and after that you cannot ask me. I'm always available on WhatsApp. You can ask me all the questions you have. Thank you. Wish you all the best. Happy New Year. Bye-bye.
Thank you, sir.